Joining us from Frankfurt is one of Europe's most influential professional economists, Thomas Meyer, chief economist at Deutsche Bank. Thomas, thank you so much for joining us today. It does seem that in terms of the European debt crisis, it just went up a notch. Angela Merkel is losing ground at home. We still have the crisis in Portugal. We're worried about Spain. How concerned are you that, again, this debt crisis is far from over?
Well, we haven't seen a final solution at the European summit of this bad debt crisis, but I think that at least for now the risks at least are concerned. What is now most important is that Portugal moves along to get a new government. And in this process that Portugal is able to meet its bond payments that they have to make in April and then in June. So presumably we'll need some bridge funding for them, and then eventually they will get a new program and we should be okay.
Thomas, how concerned are you and how surprised were you by the defeat of Angela Merkel? We talk about, the breakup of the euro as not really a possibility, but if we don't have Germany on our side, does it, mire Europe in really a huge problem?
The state election outturn was really not so much about Europe. It was a lot about nuclear power, to some extent on Germany's position on the Libyan issue. So I don't think that there is a direct implication, but of course governing has been made much more difficult for Mrs. Merkel and her coalition partner. And against that background, I think we will see probably some impact, fallout on that, on the further evolution of the European rescue packages. It could be that the German government will be perhaps even more reluctant to support further reaching solutions on the European debt issue after this election outcome.
Yeah, it is quite difficult actually to understand, certainly for other Europeans, because Germany has an economy which is ticking along nicely. Angela Merkel got her way, certainly in Brussels. So when you say it will change the way possibly that she looks at Europe, is it going to become much more difficult for countries to access a bailout, which is essentially funded by Germany?
Well, she will have to make sure that EMU is not turning into what the Germans call here a transfer union. As you know, the German public is very skeptical about German taxes being used to fund other government spending. This issue, as I said, has been faded a bit in the background lately over the Japanese nuclear incident. But it is something that certainly is very much a concern here in Germany, and the government will have to make sure that anything that is done to help countries, now probably Portugal, will not turn into giving rise to concerns that there are transfers taking place from Germany to the other countries. So there will be a lot of insistence on conditionality and appropriate policies. Obviously something that the Portuguese still have some difficulties with right now.
Thomas, I do actually want to switch the focus to Portugal, and Europe's latest fiscally endangered state will soon have to hold elections of its own. Portugal's politicians are rejecting the chance to form a unity government to fight the debt crisis. Well, the Prime Minister resigned after they tossed out his austerity budget. That left the minority government leaderless and rudderless, and now elections are set to take place close to the due date of a crucial bond redemption. Thomas, how difficult is it going to be for Portugal to survive without a bailout, and what kind of conditions will be attached to this bailout?
Yes, and we have seen the markets getting very concerned and in fact convinced that Portugal needs some help. The Portuguese unfortunately dragged out the process to such an extent and length that now we are in this awkward situation that they do not have a government that has a mandate to negotiate an adjustment program and therefore help. So we hope that there will be some money available for them to make the payments in April of roughly 5 billion euros. Another one is coming up on June 15. If they don't have the cash reserved and we don't have a program in place, we will have to look for some bridge funding. Perhaps, possibly, just about the IMF could perhaps step in and bridge until we have a viable program in place. But it's very, very awkward.
And Thomas, how concerned are you actually about, in terms of everything that we're seeing with the ECB? We're talking and we're hearing the fact that they want to raise rates, and a lot of economists are telling me they really have to be careful because there's a two-speed Europe, and if they raise these rates too soon, we risk a double-dip recession.
Well, the ECB has to make sure that they remain true to their mandate, which is running monetary policy for the entire Eurozone. And as you suggest, we have a two-speed Europe. But if they would direct their monetary policy at the slow speed, there is the big risk that they would lose the faster speed. So therefore, I think what they've decided is to use interest rate policy to direct that at the Euroland average, but phase out the non-standard measures only very gradually, so help with liquidity provision, now even with longer-term loans in the case of Ireland, the Irish banks.
All right, Thomas, thank you so much. Thomas Meyer there.